Welcome everyone. Before we get started, I just want to quickly go over some house rules. Firstly, when you enter the webinar, your microphone and camera have been turned off automatically, so no need to worry about that. Also, please feel free to ask questions in the chat function or send them to news@CEMAsys.com, and we will be able to provide you with a response following the webinar. And lastly, this webinar is being recorded for later playback if you need to come back to it at any point in the future. So now let's get started. My name is Zachary Eriquez, and I'm also joined today by John O'Neill, and we are both sustainability and climate change consultants at CEMAsys. The topic of today's webinar is Carbon Accounting 101, where we will review the basics of carbon accounting and measuring your emissions by scope. Let's briefly touch on the agenda before jumping in. First, I'm going to give you a little introduction to who we are at CEMAsys, what we do, and some of the services that we provide our clients. Then I'm going to hand things over to John as he'll dive into some details surrounding carbon accounting methodology aligned with the greenhouse gas protocol. Next, he'll move on to discussing scope 1 and 2 emissions, what they are and where they come from, and then he'll jump into the details surrounding scope 3 emissions, the various categories included in scope 3, and the differences between upstream and downstream emissions. We will also be talking about the features of a carbon accounting software, which have the ability to streamline your accounting process. And now this should take us right to the 30-minute mark, but if you'd like to stick around after this, we have planned a brief demo of the CEMAsys system where we will look at these features that we've spoken about today and give you a little more practical idea of how this can help you in your carbon accounting process. So let's jump in. So to kick things off, I'll share a little bit about us. CEMAsys was first founded in 2007 as a climate change and sustainability consultancy in Norway. In addition to our headquarters in Oslo, we also have offices in Copenhagen, Stockholm, and here in Boston. At CEMAsys, we have a two-pronged approach to providing peerless sustainability services. First, we have our smart system solution consisting of the 5 cloud-based modules that you can see at the bottom of the slide here. Today, we're going to mainly be focusing on the carbon footprint module to discuss carbon accounting. But our additional 4 modules are tailored to all types of reporting, analysis, and ESG data. In addition to the modules on our platform, the second prong of our approach involves our expert consultants who are all well-versed in understanding best practice of sustainability frameworks, like some of the ones that you can see at the top of the slide here, including the Greenhouse Gas Protocol, the Science-Based Targets Initiative, and the CDP, to name a few. This expertise makes understanding and working with these frameworks comprehensible for our clients, ensuring that we can provide the best results available. And the structure that we've established at CEMAsys allows us to be your all-in-one sustainability provider. And now I'm going to hand things over to John as he's going to take you through the methodology of carbon accounting.
All right, thank you, Zach. So like he said, I am going to start by introducing you all to the most used methodology for calculating a company's carbon footprint, which is the Greenhouse Gas Protocol. This is the most widely used method for carbon accounting around the world. The guidance recommends splitting emissions into scope 1, 2, and 3. Scope 1 being direct emissions, scope 2 indirect emissions from purchased energy, and scope 3 covers all other emissions from the entire value chain. We'll touch more on the specifics of the scopes in a bit, but this framework is really important because it has provided a very comprehensive standard to measure these emissions. And as we know, this is the first step in the process of then lowering emissions, setting ambitious targets, and reducing in line with what the science tells us we need to do. None of that is possible without a guiding standard on how to measure emissions in the first place. Like I said, we will do a deeper dive into each of these scopes, but before we do, I want to make sure we all understand the foundation of what we're talking about here. Like we said, the Greenhouse Gas Protocol provides a really nice standard for companies to use that makes everyone's carbon accounting comparable, and further, using this methodology sets your company up for success in ESG reporting beyond just reporting your annual emissions and tracking internally. There are several other frameworks, standards, and regulations that either recommend or even require you to use the Greenhouse Gas Protocol to measure your emissions in order to comply or be considered best practice. As you can see here, SBTI, GRI, TCFD, and CDP all mention or require you to calculate emissions in line with the protocol. There are also regulations coming, such as the SEC Climate Disclosure, which recommends reporting all Scope 1, 2, and 3 emissions within the draft. So, using the greenhouse gas protocol and doing a strong best practice carbon accounting will set you up for success within all of these other reporting frameworks and regulations. But let's dive into what the greenhouse gas protocol is really helping us do. So what the greenhouse gas protocol is helping us do is consider all greenhouse gases that we are emitting and try to quantify them. So you may be aware of this, but it's not just carbon or CO2 that is causing the Earth to warm up, but there's actually several greenhouse gases that we emit during our human activities that all contribute to climate change collectively. All of these gases that you see here, CH4, PFCs, HFCs, they all have different what is called global warming potential, which basically is just how strong their ability is to trap heat in the atmosphere and how long they stay in the atmosphere. So what we need to do is convert all of these into one common unit so that our reporting can be comparable, and globally that is known as carbon dioxide equivalents, or CO2e. So you may release 1 kilogram of methane, but because methane has a stronger warming potential than CO2, you will end up with a number much larger than 1 kilogram of CO2e. It actually comes out to about 28 kilograms of CO2e. And I was able to figure that out because we know the conversion factor for the global warming potential of methane to carbon. And in carbon accounting, we utilize these known conversion factors and other data to create what are called emission factors. And I want to look at a more practical example of what this means. So essentially, an emission factor is a conversion factor that takes you from your consumption or activity data and converts it into CO2 equivalents. The formula we then use is your consumption data multiplied by your emission factor, which gives you your CO2 equivalents. Now, I will get more into emission factors when I talk about quantifying your emissions, but so we all have a general understanding of how this works. Let's look at this quick example. So in this case, we have 10 gallons of diesel fuel that we used this reporting period. Maybe this was for a company truck, for example, and we can then multiply this by the emission factor, which in this case is 1.75 kilograms of CO2 equivalents for every gallon of diesel, and we get 17.5 kilograms of CO2e released when we use 10 gallons of diesel. In our carbon accounting, we then add up all the tons of CO2e from our operations and value chain to get our annual emissions. So now that we understand a little bit about how this works and why it is important to convert all emissions into CO2e, let's zoom out a little and look at the 4 steps of carbon accounting. So there are going to be 4 major steps in the process of calculating your emissions, during which you will turn all of your emissions from business activities into equivalents of CO2. The first step is to identify the emission source. In this step, you ask yourself, what are my business activities that may be associated with the release of greenhouse gases? And scope by scope, you'll identify all the activities that need to be accounted for. Now, this will be different for each company. The next step will be to collect activity data, also called consumption data. This will be, for example, the amount of kilowatt hours needed to power your lights for the year, or the amount of gas used to power your machines. If this data is not available, it is okay to make estimates or assumptions, as long as you take note of these and report them within your methodology. The third step is to quantify the emissions. We talked a little bit about this already, but in this step, we will convert activity data, so 1 gallon of gas, for example, into the equivalent metric tons of CO2 released as a consequence of burning this gas. Then, the last step is conducting a quality check to ensure our data was collected in line with best practice, that our calculations were done accurately, and that we are working towards a complete and accurate carbon accounting. We will now take you through these 4 steps and talk more specifically about how to identify sources, collect activity data in scope 1, 2, and 3, quantifying these emissions, and performing quality control overall. Starting with scope 1, as a reminder, these are direct emissions from company-controlled sources. We will go through the categories of emissions under scope 1 and some examples, but know that this is not an exhaustive list, and emission sources will differ based on which are relevant to your business activities. Starting with stationary combustion for the generation of electricity, heat, and steam. This category may be relevant to you if your company owns or operates buildings which have on-site energy production. Emissions may come from operating boilers, combustion turbines, incinerators, or anything in which emissions are directly released from your building. We also see scope 1 sources from fugitive emissions. Fugitive emissions are most often seen in the form of refrigerants, which may leak, releasing greenhouse gases. This also includes any other methane emissions, HFCs, and/or air conditioning. Next, we see mobile combustion. Mobile combustion includes any emissions from the burning of gas to power owned or controlled vehicles. This includes company cars or trucks, but also non-road equipment such as forklifts and construction equipment. And finally, there is physical and chemical process emissions. These emissions are released during any physical or chemical processes within company-owned locations. This may include emissions from the processing of chemicals or materials such as cement, aluminum, ammonia, and/or waste processing. So these are the main categories of scope 1 emissions. If you have any questions about scope 1 emissions, put them in the chat, and for now, we will move on to how to collect data for scope 1. So there are a few different ways to acquire your scope 1 data, and we've listed a few here. Overall, you'll need to gather information on both fuel consumption and fuel and vehicle characteristics. To get data for fuel consumption, you can look at sources like your company's on-site metering, purchase records, records of distance traveled in vehicles, and your refrigerant purchase quantity for knowing how many refrigerants were released in the reporting period. For the actual characteristics of the fuel and/or vehicles you're using, you can look at things like the measured carbon content of the fuel heating value, which may be in your utility bills, and if not, you can look at default heating values and the vehicle efficiency and fuel type used. With all this information, you have everything you need to quantify your scope 1 emissions. But before we do that, let's look at scope 2. Scope 2 emissions are the indirect greenhouse gas emissions that occur from the company's owned or controlled assets. These include emissions from purchased electricity, steam, heating, and cooling. They are considered indirect emissions because they are a consequence of the activities of the reporting organization, but don't occur in their own facilities, but rather the actual emissions are being released from the electricity production site. So the first and most common category in scope 2 is electricity. In scope 2, we are considering the emissions from the process of creating the electricity, and this includes electricity to operate lighting, machinery, to charge electric vehicles, and so on. I want to take a moment to address the fact that we have mentioned the generation of electricity twice now, once in scope 1 and now in scope 2. The difference between the two is that in scope 1, the electricity is being generated on site in the reporting company's operations, while here it is reported in scope 2 if you are purchasing energy from a secondary provider. Another scope 2 category is steam when purchased from an off-site provider. It is often used for mechanical work, heat, or in operational processes. And we also have heat. Most commercial or industrial buildings require heat to control interior climates and heat water for specific equipment. And finally, we have cooling. Similar to heat, Cooling may be produced from electricity or through the distribution of cooled air or water. Once you go through these categories and determine which are relevant to your company's operations, you'll need to start collecting data on exactly how much energy was purchased or used in the reporting year. And in general, the best place to look for this is going to be your utility bills. In most cases, your electricity is going to be coming from your local grid, which is the shared electricity distribution network. And why do we care where this electricity is coming from? Well, your local grid likely utilizes energy from multiple sources, and they likely use a variety of electricity generation methods, such as thermal power from coal or natural gas, wind turbines, solar photovoltaic cells, solar thermal. So for example, you may have different grids, two different grids, one in Boston and one in Norway. In this case, grid A may represent a grid in Norway, while grid B would be in Boston. Grid A's electricity mix is 50% renewable versus grid B, where only 25% is renewable. If both our Boston and Norway office used 100 kilowatt hours of electricity, but from their respective grid, the emissions from the Boston electricity use would be higher than the Nordic office use. This is because Norway's kilowatt hours would have had a higher amount of the kilowatt hours coming from the renewable sources, which of course have lower emissions. And calculating emissions in this way for Scope 2 is what we call the location-based emissions. But there are two methodologies the Greenhouse Gas Protocol provides for calculating your Scope 2 emissions. We just talked about location-based, where you take into consideration the local electricity mix, but there's also the market-based approach, which considers if your company has purchased RECs, or renewable energy certificates, and or GOs, or guarantees of origin, which are different, but in general, what they do is guarantee that a specific proportion, or all, of your electricity coming to your building is from a renewable source, while still coming from the grid. You may, for example, purchase RECs for an office to cover 80% of energy. This would guarantee that 80% of electricity came from a renewable source, and the market-based methodology then says to assume the remaining 20% is from fossil fuels. According to the Greenhouse Gas Protocol, you must disclose both your location-based and your market-based figures, but in general, companies will choose one methodology to focus on where their emissions will primarily be reported in either market-based or location-based. Okay, so that was Scope 2, which can be a little bit complex. So please, we do encourage you do put any questions you have in the chat. Now on to Scope 3 emissions. There are 15 categories within Scope 3, split up into upstream and downstream categories. Upstream categories include everything listed here. These are emissions categories in which your company may have a bit more control, like purchased goods and services. This is what you've purchased from other entities in the reporting year. You also have any transportation and distribution that is conducted by a third party, but paid for by your company. There's also business travel, employee commuting, and so on. Then we have our downstream emissions. So with downstream emissions, you generally have a bit less control over the emissions relating to these categories. So for example, you see downstream transportation and distribution, and similar to upstream, this is transportation and distribution conducted by a third-party company, but not paid for by the reporting company. So maybe you're shipping something to a retail store or a customer and they pay for shipping. That is a downstream transportation emission source. You'll also see processing and use of sold products, end-of-life treatment, and sold products, and more. Obviously, Scope 3 can get a little bit more complex. Note, though, that not all 15 categories will be relevant to all companies. So we always suggest companies conduct a Scope 3 screening to determine relevance and related activities for each category. CEMAsys will actually be hosting a webinar on August 30th in a few weeks, which will talk about your Scope 3 emissions and engaging with suppliers to receive your Scope 3 data. You can find a link to that on the CEMAsys LinkedIn page. Continuing though, Once you know your relevant categories, you can begin to collect data, which may seem like a daunting task, but keep in mind that this data, in theory, should all be available to you, whether that be through purchase records or engaging with suppliers. And there are some low-hanging fruit where you can start, such as business travel, where you likely have a list of all flights purchased by the company or a travel agency with a record. Similarly, Category 3, fuel and energy-related activities, takes your same consumption data from scopes 1 and 2 and uses different emission factors to calculate the upstream emissions to generate that fuel for direct use and energy generation. So that was our overview of the 3 scopes. Any questions, feel free to send in the chat. But in the meantime, we are going to move on to step 3, which is calculating your emissions. Okay, so taking us back to this slide, which should look familiar from the beginning of the presentation. This is step 3, emissions calculations. Here, we convert all of that activity data into CO2 equivalents. The biggest task in this step is going to be locating the correct emission factor. As a reminder, an emission factor is a conversion factor to get us from activity data to CO2e, but each emission factor is specific to the type of emission source that we are talking about. So while it may be 1.75 kilograms of CO2e per gallon of diesel, this number may be drastically different for the use of 1 kilowatt hour of electricity or traveling 1 mile in an airplane. In this example, we're trying to quantify our emissions from taking a 600-kilometer long plane ride. We find our emission factor, which is 0.15 kilograms of CO2e per kilometer of the flight, and this gives us a total of 90 kilograms of CO2e. I want to mention that in this case, we have smaller figures, so we're using kilometers of CO2e, but it is a universal standard to typically report emissions in metric tons of CO2e. So a very high-level overview of calculating your CO2e from activity data, but if you do have any specific questions about this, feel free to pop them in the chat, but we will be touching a bit more on this during our discussion of carbon accounting software. So as it says here, there are a few different types of data that you can collect and emission factors that you can utilize. Let's take an example that you bought 1 unit of paper from your paper supplier. If you were to get supplier-specific data, they would tell you exactly how many emissions were released in the process of making your 1 unit of paper. This, you will find, is pretty rare and would require your supplier to have already conducted their own carbon accounting. And while supplier-specific is the ideal method, in most cases, you will use the average data method, which is perfectly fine and in most cases the best possible method. In the average data method, you would use your purchase records to see that you acquired 1 unit of paper from your supplier, and you would multiply this by an average emission factor for paper developed by looking at the emissions of many paper suppliers, typically calculated by a third-party researcher or contained in a database. If the information of the mass or weight of the unit is unavailable, and you cannot get any information from your supplier, then you may use the spend-based method. But this is only recommended as a last resort, as it is the least specific method. In this way, you can then see that you spend $100 on paper this year. You can multiply it by a spend-based emission factor, which again would have been calculated likely by a third party to get your emissions from that purchase. In addition, it is okay to use what is called the hybrid method, which is a combination of multiple methodologies within your carbon accounting. If supplier-specific data is available for some emission sources, but not all, it is okay to use some supplier-specific and some average data. Do note, though, that supplier-specific is the most preferred method, while spend-based is the least favorable. Okay, so that wraps up our discussion for quantifying emissions. We will now move on to step 4, which is performing a quality check. All right, so we're now on step 4, quality control. So we've put together three main steps to ensuring quality carbon accounting is in line with the greenhouse gas protocol. The first part is ensuring you understand and are accounting for all emissions within your organizational boundary. The greenhouse gas protocol sets forward two general ways to define your organizational boundary, which are the equity share approach and then control approach. Each company must choose their approach and account for all emissions that fall within that scope. Next, we have the reporting principles from the greenhouse gas protocol, which include relevance, meaning that all relevant emissions are included. Next, completeness. As we've stated, we should always be striving for that complete carbon accounting, but in the meantime, all omissions should be explained. Next is consistency, meaning that your methodology between both emission sources as well as between reporting years should stay consistent to the extent possible. Transparency is a big one. Being transparent about available data, any limitation or assumptions you've made is a huge part of carbon accounting, especially when starting out. And finally, accuracy, meaning that all emissions calculations are as true to reality as possible given the available resources. We recommend reviewing these principles in the context of your carbon accounting, and there is always a big emphasis on transparency. When starting out, it is okay, like we mentioned, to not have a complete carbon accounting, but being transparent about where you are and striving to fill in your gaps year over year is a great place to start. Finally, ensuring all data is verifiable, making sure that there is a trail available in your records so that you are able to produce proof, if needed, of all consumption data and a record of all calculations, assumptions, and omissions within your methodology. Again, it is okay to not have a complete carbon accounting in year one, but you should always be striving for that complete carbon accounting, which may then eventually be verified by a third party through this traceable audit trail you've collected. All right, so we talked about all four steps, and I know this can seem like a big process, but we want to pivot to talk about how this process can possibly be made a little bit easier for you through a software solution. So there are software solutions built to make this entire process easier, and we want to talk a bit about how they can do this, keeping in mind that not all solutions may contain all of these features. But ideally, the software solution you choose will be able to streamline your process and make yearly reporting as simple as possible. There are a lot of ways our carbon accounting software can help you in the process that we just went over. First, it can help with data input ease. For example, you're able to upload large data sets as opposed to entering data one line at a time in your own worksheets. In this way, data will all be in one convenient location as well. The calculations we just went through can all be automized. The system may have a data set for emission factors ready to choose from to save you the time of researching and converting emission factors into your required unit of measure. It can also help you track emissions in line with the greenhouse gas protocol, ideally separated into scope 1, 2, and 3, where you can then track emissions by scope, location, division, and also across your supply chain. And finally, a software solution will ideally be able to summarize your data and present you with graphs and tables, not only to understand your emissions, but also for further analysis, tracking against reduction targets, and identifying emission hotspots in your operations and value chain. So that wraps up our overview on Carbon Accounting 101. But like Zach said before, we will be presenting a demonstration of the CEMAsys carbon footprint software. So stick around if you have the time, but if not, we thank you for joining and look forward to responding to your questions.
Thank you, John. And now I'm going to take you through a quick demo of our carbon accounting module and show you some aspects of a carbon accounting software that you should be looking for when choosing a provider in the future. Great. So now taking a look within our system here, we're within our carbon footprint module. So you can see at the top of the screen, we have our data entry tab, and this is where we'll be entering all of our activity data. But we also have a documents library, which stores all of your important documents, a reports tab, which I'll cover briefly in a moment, and then administrator tools, which allow you to change certain settings regarding your company's structure. This is a great aspect to have for a system to allow for a good hierarchy to be set up and organized data entry. But going back to the data entry tab that we are currently in, we have our key information here, which is where you can input your key performance indicators or KPIs, and it's extremely useful for setting up your company's structure within our system. But moving on to the scopes, we have it separated by scope 1, 2, and 3, which allows for an intuitive and organized data entry process. But moving on to scope 1, you can see here at the top that this is where you can utilize your organizational boundaries and choose which office, location, or year data that you would like to enter. Data can also be automatically imported here via Excel files or an existing system, and they will automatically show up on this page in this format. But if you don't have that, you can still report your data manually on this screen as well. But looking at scope 1, we have your activity data here, which we have as natural gas. You can utilize this drop-down menu to choose from our various emission factors. Next, you want to choose a unit of measurement. For this, we have kilowatt hours. And then you would like to enter a description. So for this, it is heat. And then the data input is where you input your figure. And then it's great to have a system that has a source option because it allows for you to show who entered the data, when it was entered, and where it comes from. But when all of your data is entered and completed, you can use this confirmed reported option by pressing yes to ensure that this office is done reporting and move on. This feature will help with project management in order to confirm reporting down the road. Next, I'm going to show you scope 2. So it's very similar in setup to scope 1. You have your data, but here we're in scope 2, so we'll mainly be talking about electricity data. The additional aspect to scope 2 is the inclusion of RECs, or renewable energy credits. So in this area, you can input your percentage of RECs that you have in your electricity, and it'll automatically calculate into your scope 2 emissions. The system also allows you to add square footage per site, which allows you to measure and compare energy and emissions intensity across all of your reporting sites. And lastly, just to show you scope 3, the data entry page looks very similar to scope 1 and scope 2, but we do have it broken down by each individual of the 15 scope 3 categories that we spoke about earlier. This makes it for easy access and easy input in very much the same way that scope 1 and 2 are entered. Just makes things a very intuitive and simple process and allows you to organize your emission data in a streamlined way. Next, I'm going to show you the reports tab that I spoke about before. So this is where all of the data that we just input is used in all sorts of ways. So looking at the dashboard here, it's a great overview of all your emissions in one place. And again, you can filter by any office or location and also do year-on-year comparisons. So we currently have it put for 2020 to 2022. And you can also check in this frame the reporting status of each office or location. And you can see how everything has been accounted for in the previous period and that there's still reporting to be done in this very last period. And if you click the drop down here, you can also see specifically what information is missing from each site, which really helps for project management. But scrolling down, I think these graphs are amazing for quick visuals that point out your largest emission hotspots. You can also see each scope compared to each other, the energy consumption that you have, and your emissions per period. But now that I've shown you this, let's move on to the main report. So the main report is great because it has so much useful information at a quick glance. We have all of your scope 1, 2, and 3 data categorized and laid out in an easy-to-view manner. Everything is also automatically converted to tons of CO2 equivalent, which is the standard, and that is very good to have in any carbon accounting software that you choose. And you also have these year-on-year comparisons that show you progress over time. And even better, you can look specifically at your market-based or location-based numbers for full transparency. In addition to that, every metric is also entered in megawatt hours in case you'd like to look at that metric. And lastly, you can also see all of the data that was originally entered in their original consumption figures. So like I said, really any data that you're looking for is going to be in this report. And this also can be exported easily for an audit trail, and it exports to Excel, making for a very standard and easy to use data set. But this export and audit function is why auditors who are verifying a company's carbon accounting love this aspect of any carbon accounting system. But lastly, let's move on, and I'm going to show you the summary report. So the summary report is another great visual that really brings together a lot of different reports. This can also be easily exported to PDF. If you would like to send it to stakeholders such as customers or investors. And then similar to the main report, you have your scope 1, 2, and 3 data all categorized where you can see your year-on-year comparisons. And you also have these visuals, which I find extremely helpful for seeing emissions at a glance. You can also see your annual energy and your key performance indicators down at the bottom here to track emission intensity. So the summary report really packs a lot into a short report, and there are so many more reports in this system that we can choose from in order to utilize your data in any way that you wish. And there really is so much more that I could talk about, but since we've run out of time today, I'm going to cut things short, and please feel free to reach out and schedule a free demo of your own, and we can get into more detail. But if you have any other questions, please email news@CEMAsys.com, and we'll be able to get back to you with a response. And I would like to thank you all for coming today. I hope you all learned a lot about what makes a good carbon accounting system, and you're ready to start your carbon accounting journey soon. Have a great day.